Hello everyone, welcome back. Today we are going to do short questions of depreciation which are given in your textbook on page number 65. So here is the question. Question number 3, answer the following question in brief. Here first one is, one machine was purchased on 1st April 2008. On 1st April 2014, the opening balance of machine account is rupees 28,000. Depreciation on machine is charged at 10% under straight line method. Here we have to write journal entry for the depreciation on 31st March 2015. So here in this question we are given rate of depreciation, that is 10%. Here it is. And we are given opening balance of machine account, that is 28,000 as on 1st April 2014. Here we are not given original cost. Original cost means cost incurred to acquire the asset up to the point it is ready for use. It is the basis for depreciation. So here opening balance as on 1st April 2014 is 28,000 and this machine was purchased on 1st April 2008. That means this machine was purchased before 6 years. And as we don't know original cost of this machine, so here we have to assume it. So if we assume cost price or original cost of the machine 100, then if 60% amount of depreciation is deducted, 60% amount of depreciation, that means rupees 60, that is 6 years multiplied by 10%, that is the rate of depreciation. So that comes to 60. So 100 minus 60, that comes to rupees 40. So 40 is the book value of machine. So if book value of machine is rupees 40, on that we assumed cost price rupees 100. So if book value is rupees 28,000, what would be the cost price? By cross multiplication, we will get 70,000 as cost price of machine. So here, as we have been given a rate of depreciation, that is 10%, and we have also found out cost of machine, that is rupees 70,000. So 10% of 70,000, that is 7,000. So 7,000 is the depreciation per year. And as this is straight line method, so here depreciation will remain same every year. So here for this, our journal entry would be depreciation account debit rupees 7,000 and machine account will be credited by rupees 7,000. Now let us move to question number 2. Here is the question. One machine was purchased on 1st April 2013 for rupees 30,000. Depreciation on machine is charged at 10% under reducing balance method. Here we have to write journal entry for depreciation on 31st March 2015. Here we are given depreciation rate, that is 10%, and here depreciation on machine is charged under reducing balance method. Here it is given that this machine was purchased on 1st April 2013 for rupees 30,000. So here cost price of machine on 1st April 2013 is rupees 30,000. We know that under reducing balance method, every year depreciation is calculated on opening balance of asset at the predetermined rate. Opening balance means closing balance of the previous year after the deduction of depreciation. So here on rupees 30,000, that is the cost price of machine, if we calculate depreciation at 10%, that comes to 3,000. So here depreciation for the first year is rupees 3,000. And if we deduct 3,000 from cost of machine, cost price of machine, that is 30,000, we will get 27,000. 27,000 is the book value as on 31st March 2014. So now for the second year, as this is reducing balance method, so here we will not calculate depreciation again on rupees 30,000, that is on cost price of machine. Here for the second year, we will calculate depreciation on rupees 27,000, that is the closing balance at the end of first year, or we can say that it is the opening balance of second year. So here every year depreciation will be calculated on the opening balance of respective year. So here 10% of 27,000, that comes to rupees 2,700. So here depreciation for the second year would be 2,700, and if we deduct it from the book value, so here we will get 24,300, that is the book value as on 31st March 2015, or we can say that this is opening balance of a third year. So here we are asked to write journal entry for depreciation on 31st March 2015. So here our journal entry would be depreciation account will be debited by rupees 2,700 and machine account will be credited by rupees 2,700. And we will write narration, that is being depreciation at 10% calculated on a machine. Now let us move to third question. Here is the question. On 1st April 2014, value of machine was rupees 34,000. Depreciation is calculated at 20% under reducing balance method. This machine was sold at 35% profit on book value on 30 September 2014. From this information, write journal entry for sale of machine. So here in this case, we are given book value as on 1st April 2014, that is rupees 34,000. And here depreciation will not be charged on the machine for full year, as it has been sold on 30 September 2014. So here we will charge depreciation for 6 months only, that is from 1st April 2014 to 30 September 2014, that comes to 6 months. So here we will charge depreciation for 6 months only. So depreciation for 6 months would be 3,400, that is 34,000 multiplied by 20 upon 100, that is 20%, that is depreciation rate, multiplied by 6 by 12, as here depreciation is being charged for 6 months only, so 6 by 12, so that comes to 3,400. Depreciation for 6 months is 3,400, and if we deduct it, we will get book value as on 30 September 2014, that comes to 30,600. And it is given in the question, this machine was sold at 35% profit on book value on 30 September 2014. So here we have found out book value as on 30 September 2014, that is 30,600. So on 30,600, if we calculate 35% of that, we will get 10,710. As it is profit, so it will be added in order to find out selling price of machine. So 30,600 plus 10,710, that comes to 41,310, that is selling price of machine. So here our journal entry would be bank account will be debited by rupees 41,310, as we are getting money by selling the machine. So here bank balance will increase. So your bank account will be debited by rupees 41,310, and depreciation, it is an expense, non-cash expense. So here we will apply the rule of nominal account. So depreciation account will be debited here according to the rule of nominal account, that is 3400, and profit and loss account will be credited as it is being sold on at 35% profit, that is 10,710. And as machine is going out of business, so as per real account, it will be credited by rupees 34,000. Now let's move to question number 4. Here it is. Hero Limited charges depreciation on its assets at 5% under straight line method. If annual depreciation amount is rupees 6,000, determine cost price of machine. So this is very simple. Here we are given depreciation rate, that is 5%. And amount of annual depreciation is also given, that is rupees 6,000. So here we have to find out cost price. So if 5% is depreciation rate and on that amount of depreciation is rupees 6,000. So if we assume cost price 100%, what would be the amount? So here by cross multiplication we will get 1,20,000, that is cost price of the asset. So here cost price of an asset would be 1,20,000. Now let us move to question number 5. Here is the question. Sarvesh Limited has purchased a machine on 1st April 2013 by charging depreciation at 10% under reducing balance method. Rupees 3,240 is recorded as depreciation on 31st March 2015. Determine cost price of machine. Here, here we have to calculate depreciation under reducing balance method. So we know that here every year depreciation is calculated on the opening balance of respective year. And here we have to find out cost price of machine. So here we will have to assume the cost price of machine, that is rupees 100. And if we deduct depreciation for the first year, depreciation rate is 10%. That means 10% of 100, that is rupees 10. And if we deduct, we will get rupees 90, that is book value as on 31st March 2014. Or we can say that this is opening balance of second year. As this is reducing balance method, so here for the second year we will calculate depreciation on book value or opening balance of second year, that is rupees 90. So 10% of 90 is equal to rupees 9. So depreciation for the second year is rupees 9. If we deduct it, we will get book value as on 31st March 2015, that is opening balance for the third year. So here we have been given total depreciation, total amount of depreciation for the second year, that is rupees 3,240. And when we assumed cost price of an asset rupees 100 as on 1st April 2013, on that our depreciation for the second year was rupees 9 as per that assumption. So here we will calculate it as for if rupees 9 is the depreciation for the second year, at that time we assumed cost price rupees 100. And so what would be the cost price if the total depreciation is rupees 3,240? So by cross multiplication we will get rupees 36,000, that is cost price of the machine. So I hope you would have understood this. That's all for today. Thank you very much.